Hello. So this is chapter 3, level 1. So this chapter we are going to discuss about the Canadian regulatory environment. So what important role does regulation in the industry play? So the most important role, what is regulation? So regulation is like policing. So if every member is behaving in an ethical way, are instruments traded in an ethical way, and are the investors protected? So, if investors are not protected from fraud, if there is no regulations there, investors would not invest their hard-earned money. So, regulations are important because it enable and promotes investing. Is more or less regulation needed or required? So, there should be a balance. Too much regulation will hinder the progress of capital market. Too less regulations will enable frauds and all those things to happen. So there has to be a balance. How is fairness and efficiency in Canadian markets achieved? So it is achieved through regulations. In Canadian markets, regulations is responsibility of provincial governments. So American markets, if you see, there is a centralized body known as SEC, Security Exchange Commission. That's a national body that oversees entire regulation of American capital markets. But in Canada, we don't have that. We have provincial regulators. So each province is responsible for regulations within those provinces. But in recent years, if you see, we are moving towards American system. So all these provinces are coordinating between them to establish a common framework. So though we don't have a national regulator like SEC, we have provincial regulators. We are moving towards a common system. So who regulates security industry in Canada? Is it federal government, the OSC, or the provinces? So provinces regulate the security industry. So issuing of security is a provincial responsibility. So the federal government provides some consumer protection through the Companies Act and Fraud Act. SROs and exchanges regulate the trading of securities with the goal of protecting investors and enhancing the efficiency and competitiveness of capital market. So we'll see in how it works. So regulatory organizations, if you see, so regulatory organizations are provincial security commission. So each province has a security commission that regulates security market activities that happen within that province. Then stock exchanges also have some regulatory responsibilities. What are stock exchanges? Stock exchanges are places where trading happens. Office of Superintendent of Financial Institutions. So this is a central body. This is a federal body. So that also has some regulatory responsibilities. Then there are self-regulatory organizations. So SROs are responsible for regulating their own members. Examples of an SRO will be the CPA Association. So CPA Association is responsible for regulating CPAs in Canada. So there are different SROs in terms of investment space that are responsible for regulating their own members. Investment Industry Regulatory Organization. This is important because this is a central body. Except Quebec, it deals with all the other provinces. So Quebec has its own body, but apart from Quebec, all the other provinces are members of Investment Industry Regulatory Organization. It regulates dealers, investment dealers majorly. Mutual Fund Dealers Association, it regulates mutual fund dealers. So it's a national body except Quebec. All other provinces are subscribed to MFDA. Then there are insurance corporations, the Canadian Investor Protection Fund and MFDA Protection Fund. So these provide insurance on deposits that are there with investment dealers or with mutual fund organizations. and there are other provincial insurance corporations. So what is an SRO? SRO is a private industry organization. So industries that are working in the same domain, they come together and form an SRO. So SRO regulates a particular industry, enforces members' conformity with securities legislations, can prescribe their own rules of conduct and financial requirements for members. It delegated regulatory function by provincial regulatory bodies. So what happens? There is Provincial Securities Commission. These commissions delegate some of their responsibilities to SROs. Provincial Security Commissions monitor SRO's conduct. SRO regulation apply in addition to provincial regulations. So if you're working in province of Alberta, so you will be in an SRO. Let's say this SRO. This is an SRO. The Investment Industry Regulatory Organization. So IIROC. So this is an SRO. So you will be part of that SRO, and you will also be part of Alberta Security Commission. So Alberta Security Commission delegates some of its responsibilities to IIROC. Now IIROC will have certain additional rules along with the Alberta rules. So you're responsible for adhering to those rules. Canadian SROs are majorly IIROC. So IIROC majorly deals with investment dealers and brokers. So investment dealers and brokers. So it means distribution of financial products like shares, bonds, and debentures. They come under the overview of IIROC. So direct financial investments apart from deposits in bank, all are dealt with IIROC. Then indirect investments like mutual funds, ETFs, all these comes under MFDA, that is Mutual Fund Dealers Association. So this organization, these both are SROs. So IIROC is formed by investment dealers, like means Scotia Trade, then RBC Trade. All these investment dealers have come together and formed an industry body called as IIROC, and all the mutual fund distributors have come together and formed this MFDA. Now, an important point to note, they regulate dealing, they regulate trading in mutual funds, in stocks or bonds. Mutual funds if it is MFDA, stocks and bonds if it is IIROC. They do not regulate issuers. So they do not regulate the companies that are issuing. So they do not regulate the mutual funds that are issuing. They only regulate buying and selling of those mutual funds or buying and selling of those stocks and bonds. So IIROC regulations. So financial compliance monitors capital and financial requirements of member firms. So to become a dealer or to become a broker that buys and sells stocks on behalf of client, or that enables clients to buy and sell stocks, you have certain guidelines to be met. So you need certain amount of capital and you need certain amounts of other financial requirements. So those requirements are set by IIROC. Business conduct monitors to ensure policies and procedures are in place to properly supervise handling of client accounts. Registration oversees professional standards and educational program. So if you are an employee that is working with an investment dealer or with an investment broker, or you are dealing with certain financial products, so your educational and professional requirement, your educational requirement is guided by IIROC. So it determines what educational requirement is required. Enforces, investigate complaints received against a member firms or a registered employees. CIPF is a protection fund that has started by IIROC. So it offers protection against loss due to bankruptcy of SRO funds. So if you have an account with Scotia Trade and Scotia Trade goes bust, so your account with Scotia Trade is protected by CRPF. So it protects you from the dealer going bust. It doesn't protect you from making bad investments. So if you invest in, let's say, cannabis stock, and the stock goes down and you lose money, you're not protected for that. You're protected if the dealer goes bust and your account gets damaged due to that. All accounts of customers are covered either as a part of customer's general account or separate account. So covers customer losses in securities and balances that result from insolvency with certain limit. 1 million loss for related to security and cash balances. Separate account each limited to 1 million unless combined with other services. So what does it mean? So each account that you open with these firms, it is protected up to $1 million in case the firm goes bankrupt. So you can have general accounts or separate accounts. Separate account example is RRSPs or tax-free savings accounts that you have. These are separated accounts. So ROC also has a gatekeeper role, so protecting the market from potentially illegal client activity. So this body sets out specific rules regarding the function and reporting requirement of gatekeeper. So gatekeeper means all the members that are trading have a responsibility of knowing their client. So if the client is doing money laundering, if the client is doing terror financing, so these dealers have to be the gatekeeper. They should report such activities. So concerns involve money laundering, terror financing, financial fraud, and illegal insider trading. So if these activities are conducted by their client, dealers and brokers have the responsibility to report it to the particular authority. So how do they do it? The logic is know your client. They should know what clients they are dealing for. An investment advisor is considered to have level of knowledge and understanding that is superior to his or her client. The know your client rule states that salesperson must use due diligence to learn the essential facts relative to every client, every account accepted, and every order. Therefore, the onus is on advisor to learn essential facts about a client before entering into business. So, whenever you are working as an investment advisor, you are responsible to know your client. You should know whether there is some illegal activity going on in your client's account. Continuous disclosure. Once a reporting issuer has distributed securities, the company must comply with timely. So, if you're working as an investment advisor, it is your responsibility to disclose every fact about the financial product that you are dealing with. Every fact means what are the fees, what are the features, are there any changes in the fees, are there any changes in the features. You should continuously disclose this fact to your client. Filing with administrators annual and internal financial statements meeting prescribed standards of disclosure and any material changes required, sending to the shareholders quarterly statements, all these you have to keep on doing. Investors rights. There are 3 statutory rights available to purchasers of security. Right to withdrawal. So within a certain period, if you don't like that investment, you can withdraw. Right of a recession. So if you have certain problem with that product, you should be able to sell that product. Right of action for damages. So if you're damaged due to some wrong practices, there should be a mechanism to fight for those damages. Right of withdrawal. The relevant security legislation usually provides purchasers during a distribution by a way of prospectus with the right to withdraw from an agreement to purchase security within 2 business days after the receipt or deemed receipt of prospectus by giving notice to vendors or its agents. So within 2 business days, if you don't like the product, you can withdraw. Most provinces give purchasers during distribution by a way of prospectus the right to rescind or cancel a contract for purchase of security if the prospectus or amended prospectus contains a material misrepresentation. So your right of 2 business days is extended for a certain period if you find any misrepresentation in the prospectus. Right of action for damages. If there is misrepresentation, you can sue for damages. The Act of most provinces provide that issuers, the directors of an issuer or seller of the security, and other person who signed the prospectus are liable for damages if the prospectus contains material misrepresentation. So, as a shareholder, have you are also eligible to know about takeover bids. So what are takeover bids? Offer to shareholder to purchase shares. Offerer will own more than 20%. Takeover bids, circular, director circular, and early warning disclosure. So if you are a shareholder in a company and if any significant takeover bid is coming, so if a competitor is buying your company, then you have the right to be disclosed about that takeover. What is insider trading? Insider trading are generally defined to include. So what is insider trading? Having material information before the market knows it is called as insider trading. For example, I am the sales head of Costco. So I know the sales figure of Costco's. So if sales of Costco's are very good this quarter, so I know it before the market knows it, because market will know it in quarterly statements, but I know it every monthly. So what if I buy the stock, and when the information becomes public that Costco's sales are good, the stock goes up and I sell the stock then. So this is insider trading. I have material information like the sales figures. So, and the information is non-public, that is not available to the investing public. If I trade on such an information, then I'm insider trading, and then I'm doing insider trading. It is not legal to do it. A director or senior official of the company or a subsidiary, if it trades, then that is called as insider trading. A person of company who owns or controls more than 10%, a director or senior official due to ownership, control, or direction that is involved. The insider must report to administrator details of any changes from previous report within 10 days. All reports filed with administrators are open for public inspection. So you need to disclose if you want to buy and sell stock. So this is the regulatory aspect of Canadian markets. I would strongly recommend you to read the book for this chapter, because there are a lot of regulatory things that you need to remember.